Step into the world of legendary trader Jesse Livermore with 25 powerful trading lessons from the greatest trader. Livermore's journey began in the 1870s when, at a tender age, he honed his skills in tape reading, becoming so proficient that even established bucket shops shied away from trading with him. By 1929, he had amassed an astounding $100 million fortune, only to lose it all due to disregarding his own trading principles. Dive deep into Livermore's experiences and glean essential insights that transcend time and market fluctuations. Join us on this insightful journey through his 25 trading lessons, uncovering invaluable strategies to elevate your trading game. Livermore's roller coaster journey teaches us that even the most successful traders can stumble. Learn from his triumphs and setbacks to fortify your trading decisions, ensuring a more stable and prosperous path for yourself. Don't forget to hit subscribe and like to never miss our insightful content. Number 1. Watch the market leaders. Think of the stock market like a race. In a bull market, when things are going well, there are certain stocks leading the way, like the fastest runners in a race. These stocks are known as market leaders. These leaders show where the opportunities and money-making potential lie. When these stocks do well, it's a sign that the overall market is doing well too. So, paying attention to these leaders helps you understand how the whole market might perform. If you can't make profits with these top-performing stocks, it's tougher to do well in the stock market overall. Keeping an eye on these leaders helps you focus on a smaller group of stocks, making it easier to manage and control your investments. Number 2. Markets are driven by humans, and human nature never changes. The stock market is like a big playground where people play games. What happens in this playground has happened before and will happen again and again. Why? Because people act in similar ways due to their feelings like wanting more, being scared, not knowing enough, and wishing for good things. These feelings are like a part of who we are, and they affect how we do things, especially in the stock market. So, the way prices move up and down follows patterns that repeat themselves. These patterns aren't exact copies, but they're pretty similar each time. Why? Because it's people who make these patterns by how they act in the market. And since people don't change how they feel, the patterns keep happening. Number 3. Markets are never wrong, but opinions often are. Imagine you're trying to guess which way a river will flow, but sometimes it goes in a direction you didn't expect. The stock market is a bit like that river. Sometimes it doesn't follow what people thought it would do. When this happens, smart investors don't stick to their original guesses. Instead, they watch what the market is actually doing and go along with it. It's like going with the flow of the river, even if it surprises you. The market itself isn't wrong, it just does its own thing. But the ideas and predictions people have about it can be wrong sometimes. So, it's essential to pay attention to what the market is showing rather than sticking stubbornly to your own opinions. After all, the market has a sneaky way of fooling most people most of the time. Number 4. It was never my thinking that made the big money for me. It always was my sitting. Making money in the stock market is often seen as a fast-paced game where quick decisions lead to immediate profits. But sometimes, the rush to make money quickly can lead to costly mistakes. One common saying is, "You never go broke taking profits," suggesting that it's wise to cash in on any gains. However, this strategy might not lead to substantial wealth, especially in a thriving market. One example of a mistake is holding on to losing investments while quickly selling off the winners. It's like nurturing a sickly plant and discarding a healthy one in a garden. The smarter approach is to cut your losses by selling the stocks that aren't performing well and holding on to those that are generating profits. People often lose in the market not because it outsmarts them, but because they get restless and make impulsive decisions. Old Turkey, a seasoned investor, understood the value of patience and staying true to his convictions. He knew that success in the market requires a steady hand and the wisdom to wait for the right opportunities. Here's the real secret. My success in making significant money in the market didn't come from genius ideas. Rather, it came from the discipline of patience and the ability to hold on to investments even when others might panic. Therefore, the key to substantial gains isn't always about making rapid moves, but about knowing when to stay firm and patient. Number 5. You can win on a stock, but you cannot beat Wall Street all the time. Think of being in the stock market like being in a game. It's smart not to play all the time. Sometimes, it's better to sit on the sidelines, especially when you're not sure which way the game is going. That's when I keep my money as cash until I get a clearer idea of what's happening next. The biggest losses happen when the overall direction of the market changes. Imagine you're in a horse race. You might win one race, but you can't always beat all the races. Similarly, in the stock market, you might make money on a stock, but you can't win against the market all the time. It's just not possible. There are two types of fools in this game. The one who always makes wrong moves, and the one who believes they have to trade all the time. Making smart decisions in the stock market doesn't mean buying and selling every day. No one can gather enough good reasons or know everything to make successful trades every single day. Remember this: when I'm sitting on the sidelines doing nothing, those who trade constantly are making mistakes. These mistakes they make today can become opportunities for me tomorrow. So sometimes, not being in the game is the smartest move to benefit from others' errors. Number 6. Actions in the stock market matter more than words. Imagine you're playing a game where everyone talks about what they'll do, but what truly matters is what they actually do. That's exactly how it works in the stock market too. In this game, people might talk a lot about their plans and strategies for buying or selling stocks. They could say they'll buy this stock or sell that one, but what really counts is the action they take. It's not about their words. It's about their real moves in the market that make the difference. You see, anyone can talk a big game, but it's the actions they take, actually buying or selling stocks, that matter in the end. That's what truly shapes their success or failure in the stock market. So remember, in this game, it's not the talk that matters, it's the walk. The real actions people take in the market. Number 7. Trading success hinges more on emotions than intelligence. Trading in the stock market isn't just about making smart choices, it's about dealing with emotions too. It's like a battle where controlling your feelings is as important as making clever decisions. Success often depends on managing emotions amidst the ups and downs of trading. Number 8. I believe that the public wants to be led, to be instructed, to be told what to do. Imagine a big group of people in the stock market acting like a herd of animals. They tend to stick together, moving all at once because they feel safer that way. Just like animals seek safety in numbers, people in the stock market prefer to act together in a big group. They're scared to stand alone because they feel safer when they're part of the crowd. It's like being a calf. No one wants to be the only one standing on a scary, empty prairie where wolves could be lurking. So, in the stock market, people often move together because they feel more secure as a part of the group, avoiding the risk of standing alone with a different opinion. Number 9. I believe that having the discipline to follow your rules is essential. Speculators are people who try to make money by predicting how the stock market will move. But without a solid plan or tested strategies, they're like soldiers in a battle without a plan from their general. Imagine a general going into a battle without a strategy. They won't know where to attack or defend. Similarly, speculators without a clear plan can only keep reacting to whatever happens in the stock market. They'll buy or sell based on the market's ups and downs without a clear direction, just like a soldier who doesn't know where the enemy is or how to fight strategically. Without a set plan, speculators keep reacting to market changes, often leading to losses. Having a well-thought-out strategy helps speculators make informed decisions rather than just reacting to market movements. Number 10. If stocks keep you awake, you've likely taken too much risk. If your investments in the stock market are causing you so much worry that you can't sleep, it's a sign that you might have taken on too much risk. To fix this, it's advisable to sell some of your stocks or investments until you reach a level where you feel comfortable and can sleep peacefully without stressing over your portfolio. Essentially, reducing your investment exposure can help bring your stress down to a more manageable level. Number 11. Stocks are always open for buying or selling, regardless of their highs or lows. In the world of investing, there's no specific, perfect moment to start buying or selling stocks. Whether the stock prices seem high or low, it shouldn't prevent you from making investment decisions. When stocks appear high, some people might hesitate to buy, thinking they've missed the opportunity. On the other hand, when stocks are low, people might fear selling, thinking it'll drop further. However, the idea here is that regardless of the stock's current price, what matters more is the value and potential growth it holds in the future. The key is to focus on the underlying value of the stock and its potential for growth, rather than being overly concerned about the current price. Sometimes, great companies continue to grow even when their stock prices seem high, and selling at what appears to be a low point might mean missing out on potential future gains. Number 12. I never argue with the tape. When someone says they are long on stocks, it means they expect the stock prices to rise because they're optimistic about the market conditions. They've likely analyzed various factors and believe the stocks will perform well in the future. However, there's a trap some fall into: being bullish about the market simply because they already own stocks. This can cloud their judgment because their ownership influences their optimism rather than clear analysis. In essence, they let their possessions do the thinking for them. The person speaking here doesn't let what they own or their biases influence their decision-making. They follow the tape, referring to the actual movements and signals of the market. They rely on market indicators and trends rather than letting their ownership or biases guide their beliefs about the market's direction. So, the message is to make decisions based on clear analysis and market trends rather than letting personal ownership or biases dictate one's optimism about the market. Number 13. Not taking the loss. That is what does damage to the pocketbook and to the soul. When it comes to losing money, the person in this statement isn't really bothered by the actual loss. They're okay with it and can easily forget about it once it's happened. However, what truly troubles them is when they're wrong but refuse to accept it and take the necessary steps to cut their losses. This stubbornness, rather than the financial loss itself, ends up causing more harm to both their wallet and their inner well-being. Essentially, it's more damaging to deny a mistake than to accept a financial loss. Number 14. I trade on my own information and follow my own methods. When it comes to trading, some people have access to different kinds of information or have their unique ways of doing things. That's what this rule is all about. It's like saying, I'll make decisions based on what I know and how I understand the market, rather than just following what everyone else is doing. This personalized approach helps traders stay true to their own understanding and methods, which can sometimes give them an edge in the trading game. Number 15. Trade along the path of least resistance. Imagine a stock that's been going up steadily for a long time suddenly starts to decrease slowly, with only occasional small increases. When this happens, it's clear that the easier path for the stock's movement has shifted from going up to going down. In this situation, the quote suggests that when the trend changes from positive to negative, and the stock is consistently showing a downward movement, there's no need to keep asking why it's happening. The reason for this change probably exists, and there might be very valid explanations behind why the stock is going down. Essentially, when a stock's direction changes and it starts declining after a long rise, it's more sensible to accept that the trend has shifted and focus on the new direction rather than repeatedly seeking explanations for why it's going down. There are likely valid reasons behind the change, and it's more important to adapt to the new reality than to keep questioning why it's happening. Number 16. I don't buy long stocks on a scale down, I buy on a scale up. When someone is pessimistic about the stock market, bearish, they tend to sell stocks expecting the prices to fall. In this case, each sale they make is usually at a lower price than the previous one, aligning with their belief that the stock's value will keep dropping. On the other hand, when they're feeling optimistic, bullish, and want to buy stocks because they think the prices will rise, they follow a different strategy. They buy stocks gradually as the prices go up. They avoid buying when the stock's value is declining, but instead wait for it to show a consistent increase before making their purchase. So, their selling and buying strategies are based on their outlook, selling gradually as prices decline in a bearish market and buying gradually as prices ascend in a bullish market. Number 17. Don't be fooled by the charisma of other traders. Imagine you're a trader in the stock market. Sometimes there are people who have a strong, charming way of convincing others about what to do with their money. They might be really smart and persuasive. But here's the catch. Just because they seem convincing doesn't mean they're always right. The problem is, traders might get influenced by these charismatic people and make decisions based on their charm rather than good judgment. This can be super risky because it might lead to making choices that aren't really smart financially, and that could end up costing a lot of money, sometimes millions. So, this quote warns traders to be careful and not let a persuasive personality lead them into making bad money decisions. Number 18. Know yourself. When stepping into trading in speculative markets, it's crucial to understand yourself thoroughly. Think of it as knowing yourself like a book you've read cover to cover. Why? Because trading involves making constant decisions amidst uncertainties and pressures. Knowing yourself means recognizing your strengths, weaknesses, and how you respond to different situations. Are you patient or easily tempted by risks? Do you handle stress well, or does it make you anxious? This self-awareness acts as your guide. It helps you leverage your strengths and manage your weaknesses while navigating the unpredictable world of trading. By understanding yourself deeply, you can make wiser decisions and handle the challenges that come with trading more effectively. Number 19. Fear and greed are your greatest enemies. In trading, there are two strong instincts that can mess with your decisions. Firstly, when things go wrong in the market, you might hope that somehow everything will suddenly turn around. This hope can make you stick to losing investments for too long, causing bigger losses because you're not thinking rationally. Secondly, when your trades are doing well and making money, fear can kick in. You start worrying that these good times won't last, so you might sell too soon to secure the profit. This fear can stop you from letting your profits grow. Successful traders need to fight against these instincts. They have to control the urge to hold on to losing trades forever because of hope, and avoid leaving winning trades too early out of fear. It's about finding a balance and making decisions based on analysis rather than letting emotions take over. Number 20. Trading is not a get-rich-quick scheme. Think of speculation like playing a thrilling game where you're trying to predict what will happen in the market. It's super exciting because there's always something happening, and it's like solving a puzzle with your money. But here's the thing. Not everyone can excel at this game. It's not for people who don't take the time to understand how it works, those who aren't willing to learn or work hard, or those who make impulsive decisions based on emotions. It's also not for those who think they can make a fortune overnight without really putting in the effort or thinking things through. People with these mindsets might not do so well financially. They might end up losing money instead of making a profit because they aren't approaching the game in the right way. So this points out that speculation isn't just about luck or taking big risks. It's a game that requires smarts, hard work, and a balanced approach. Otherwise, the chances are high that they might not do so well in this game. Number 21. Being a little late in a trade is insurance that your opinion is correct. Think of it like waiting for a bus. You might see the bus stop, but you wait until the bus actually arrives before getting on. In trading, it's similar. Don't rush into a trade just because you think the market will go a certain way. Instead, wait for the market itself to show signs confirming your prediction before making your move. Being patient and waiting for these confirmations is like making sure the bus you're boarding is the right one. It reduces the chances of making a wrong decision and gives you more confidence in your trade. Number 22. Never average losses. Say you make a trade like buying stocks and it doesn't go as planned, you end up losing money. It might be tempting to try again to make up for that loss by making another trade. But here's the catch. It's not a great idea. It's like saying, "Oops, I lost some money, but I'll try again and put more money in to make it right." But usually, that's risky because you might end up losing even more. Instead, it's better to learn from the first loss and not keep adding more money to try to fix it. Remembering this rule can save you from making bigger losses. Don't keep adding money to losing trades. It's not a good plan. Number 23. The trend is your friend. Think of trading like following a river current. When you're in a boat, it's easier and safer to go with the flow of the river, right? Well, in trading, successful traders do something similar. They follow the direction the market is moving in. This is called the trend. It's like recognizing which way most people are going. If everyone's buying certain stocks and the prices keep going up, it's easier and smarter to join in and buy those too. Going against the trend is like rowing against a strong river current. It can be harder and riskier. So the golden rule here is, go with the flow of the market. If everyone's going in a certain direction, it's usually a good idea to follow along because the trend is your friend. Number 24. Always trade with a stop loss. When you trade, it's super important to have a plan. Imagine you're buying or selling something like stocks. You need to know when you want to sell if the market doesn't go your way. This helps protect your money. Following rules is key, like never losing more than 10% of what you started with. Think of it like this. If you lose money, it takes more effort to get back to where you started. So it's smart to set a limit on how much you're willing to lose. This is called a stop, and it's like a safety net you put in place before making a trade. Number 25. Don't try to play the market all the time. Just like how people need breaks from work or school to relax and recharge, in trading, it's super important to take breaks too. Trading can be like a non-stop roller coaster. It's thrilling, but can be tough on your emotions. So every now and then, it's a good idea to step back and take a break. Going to cash means keeping your money safe and not actively trading for a bit. Trying to trade all the time is like trying to run a marathon without stopping for water or rest. It's too tough on your emotions and can make decisions harder. Taking breaks helps refresh your mind and emotions, making you a better trader in the long run. Remember, even in trading, it's okay and sometimes necessary to take a breather. I recommend you watch the next video in our series. Don't hesitate to share this video. Subscribe to our channel and share your thoughts in the comments section. Thanks for watching, and we'll see you in my next video.